Ladies and gentlemen, good day and welcome to Aptus Value Housing Finance India Limited Q2FY25 earning conference call hosted by Dolat Capital. As a reminder, all participant line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mrs. Mona Khetan from Dolat Capital. Thank you, and over to you, ma'am. Please go ahead.
Earnings conference call of Aptus Value Housing Finance to discuss its Q2 and H1 FY25 performance. We have with us the senior management from Aptus to share their industry and business insights. I would now like to hand over the call to Mr. Anandan, Executive Chairman Aptus, for his opening comments. Over to you, sir.
Thank you, Mona. Ladies and gentlemen, good afternoon to all of you. I am Anandan, Executive Chairman of the company. I welcome you all to the conference call to discuss the company performance for the quarter half year ended September 2024. I have with me Mr. P. Balaji, MD, Mr. C.P. Manoharan, CD and CBO, and Mr. John Vijay, CFO. The financial results and the investor presentations are already available on the website of the stock exchange as well as the company. I hope you had a chance to look at it. With low mortgage penetration and significant housing shortage across regions, more particularly in Tier 2, Tier 3 and 4 cities where we operate, and with government initiatives including recent support scheme supporting the sector, we believe that we are having significant headroom for growth to serve the underserved, unserved customers, largely in self-employed segments. At Aptus, we believe in strong growth without losing focus on the quality of loan book and good financial metrics. Very happy to record that Aptus had a very good first half year FY25, supported by business growth, stable asset quality, and continuous focus on our productivity. Sharp focus, business focus, good distribution network, deep penetration in served markets, customer centricity along with appropriate tech support and diversified income streams have enabled the company to achieve good business results. As you know, our net worth stands over 4,000 crores, resulting in robust capital adequacy. This, coupled with good support from institutions like MSBs, banks, mutual funds, and DFI on the borrowing side, and with strong on-ground demand for both home loans and small business loans, gives us confidence to pursue strong growth in the coming years with sustained profitability. I would now hand over the line to Mr. P. Balaji, MD, to discuss the business focus, operating and financial parameters. Thank you. Thank you, sir. Good afternoon, friends. As we have been explaining in the earlier call, we will continue to focus on key strategies, namely growing disbursement and loan book, both in housing loan and small business loan, considering the large headroom available in the low and middle income segment in Tier 3 and 4 cities. Expanding operations contiguously in the states of Odisha and Maharashtra, and increasing penetration in existing geographies by opening new branches. Strengthening the analytics and digital adoption, about 20% of our business in Q2 FY25 has come from customer referral app, construction ecosystem app, and through social media channels. Our focus has been to increase the leads through these channels in addition to the physical branch network. Continue to focus on productivity, collection efficiency, OPEX, and cost of funds. During the quarter, the new mobile-first lead management software, which was launched in April 24, settled well and is bringing in good improvement in terms of streamlining our processes, service delivery, lesser bounds, improved collection productivity, better regulatory compliance, and improving overall efficiency. We are continuously monitoring the functioning of this new system to bring in more improvements. Major performance highlights for this quarter half year was as follows. AUM grew by 27% year-on-year to 9,679 crores. Disbursements during the quarter increased by 26% year-on-year to 935 crores. Sequential quarter-on-quarter growth was at 39%. We had 291 branches as on date. During the quarter, we opened 24 branches, and for the half year, we had opened a total of 29 branches. Plan for the year will be to add a total of 40 branches. Total live customers were at 1,45,000 customers, growth of 27% year-on-year. NPA was at 1.25%. In terms of asset quality, collection efficiencies were at 99.28%, and our 30 plus DPD marginally improved to 6.24% as on 30th September as compared to 6.31% as on 30th June. Net NPA was at 0.94%. Provision coverage has been maintained consistently at 1.03% as on 30th September. We are carrying a total provision of around 100 crores, including a management overlay of 45 crores. On this, when computed as a percentage of NPA, works out to a coverage of 82%. NIM was at 13.02%. OpEx to assets were at 2.65%. Profit after tax was at 354 crores, representing a growth of 22% year-on-year. ROA was at 7.77% and ROE was at 18.3%, which is one of the best in the industry. In terms of funding, during the quarter, we diversified our borrowings further by issuing NCDs worth 400 crores to mutual funds. Of the total borrowing, 59% is from banks, 19% from NHB, 11% from NCB, issued to mutual funds and ISP, and the balance in the form of securitization. Sufficient on-balance sheet liquidity of 1,239 crores is maintained, including an undrawn sanction of 550 crores from banks. As you are all aware, we have not done any direct assignment of loans, leading to front-ending of income on account of this. Now, with these remarks, I open the floor for the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a minute while the question queue assembles. The first question is from the line of Ranish from ICICI. Please go ahead.
Yeah, hi sir, and congrats on a good set of numbers. So just two questions from my side. One on the LAP book, right? So, is it possible to share, let's say, what percentage of our LAP book customer might have MFI loans?
Actually, there is no overlap. We just did a scrub report for the live customers we have with us. Actually, there is no overlap of MFI customers with the kind of our customers.
Okay. And secondly, given there is a lot of noises around the growth, for NBFCs, do you foresee any risk to our near-term growth targets because of the regulatory pressure?
No, I think this will be a question which will be in the minds of quite a few analysts and the person who are in the call. I would like to explain this RBI stance which we have understood in a certain way. I'll just clearly explain this. I think then we can take it forward. From what we understood, RBI seems to be more uncomfortable on the following things. One is unsecured loans, MFI. Unsecured loans, personal loans, and consisting of personal loans and consumer loans, including the loans given by fintech companies, and secured loans with very small ticket size from say 2 to 3 lakhs. They seem to be uncomfortable if these companies want to grow at 40% or so, and they also seem to be uncomfortable about the immediate interest rates charged by them at over 24%. And they are also not comfortable with netting up of loans leading to evergreening of loans, which is being practiced by some of the players in the industry. They are also insisting on the fact about the importance of being transparent with the customers in terms of pricing and fees that is being collected from the customers. All this, I would like to have studied. We have already studied the impact of this in terms of impact on assets. First, we are in fully secured loans, both in housing and non-housing, and the security is mostly self-occupied residential property. And we are giving a guidance of 30% AUM growth at a lower base, and we are also charging interest rates which are reasonable across products. Our APS is around 8 to 9 lakhs with an LTV of around 35 to 40%, which means the security value is around 30 lakhs or more. And we do not follow any netting of loans in assets. In terms of transparency with the customers, we have been transparent in terms of communicating the interest rates and other changes, both in the sanction letter, MITC, and also in the website. Further, we also communicate this in the vernacular language. Hence, we are not impacted by this RBI stand, which is being taken across companies.
Yeah. Got it. This is very helpful, sir. And just last question. On the provisioning front, so if I remember correctly, last quarter our provisioning was lower because we have stopped creating management overlay. But then this quarter, there has been a significant jump in the provisioning. So is this due to the higher write-offs in this quarter?
No, it is not that. See, if you look at the provisioning, it has just reduced very marginally from 1.05% to 1.03%. And regarding the write-off, what has happened is, if you look at the provision movement after the provision coverage issue, there is a movement of almost 4.78 crores, and the debit in the P&L is almost 9.51 crores. This is basically because of our conservative accounting policy of more than 24 months overdue accounts getting technically written off. But there is also how we need to look at this is, you also need to look at the other income where there is an increase of almost 46%, where the bad debt recovery also has been factored in. If you look at that, for this quarter, we have got a recovery of almost 2.77 crores. So that's how you need to look at it. And the provision coverage, as I told you earlier, we are having almost 100 crores of provision. Of that, 45 crores is the management overlay. And the actual provision required as per the initial model is just 55 crores.
And to add to what Mr. Balu said, the debit to the P&L account is slightly, the provision, unusual provision to the debit to the P&L account is slightly higher than the first quarter, mainly because there is an increase in the loan book of about 650 crores between the first and second quarter. So on that also we carry the other provision.
Got it. No, this is very helpful, sir. Thank you and best of luck.
Thank you very much.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, sir. Good afternoon. Thanks for the opportunity. 2 or 3 questions. The first one is around...
Sorry for interrupting you, sir. Your voice is not clear.
Just 1 second. Hello?
Yeah, please continue.
So the first question is around the yield, sir. When I look at the yield, the blade is around 17. Can you check the yield?
I'm not able to hear you, Shubhranshu.
Okay.
Sorry for interrupting you. Shubhranshu, sir, your voice is not clear.
Just 1 second. Hello, is this better?
Yes, now it is clear.
Sure. So the first part is, can we yield of each asset class that we have on book as well as on disbursement? Because when I look at the yield, it's roughly around 17.5% on the book, which is blended. Any particular regulatory audit remarks that we have got because of this? Because the regulator has been speaking about high IRRs on various asset classes.
Not clear at all. Why is it totally breaking and not clear, Shubhranshu?
Maybe I'll come back in the queue if my voice breaking.
You can give me a call also, I can explain.
Yeah, I'll do that, sir. Sure.
Thank you. The next question is from the line of Abhishek Agrawal, an individual investor. Please go ahead.
Hi, am I audible?
Yes, you're audible.
Yeah, congratulations on a great set of numbers. So what I've noticed that in the few quarters that have gone by, on the borrowing side, the floating percentage of our borrowings is going up. So could you share your strategy on what number ultimately we are looking at on the floating versus fixed side? And the other question that I would like to understand on is that the asset book, the 80% of it is fixed. So going forward, when we presumably would see a rate cut, are we confident of not losing customers who might want to refinance these loans with banks who would pay on floating interest? So those are my two questions. Thank you.
First, if you look at the borrowings, if you look at our leverage, it is around 1.5 times now. And we would like to, if you look at our capital adequacy ratio, it is around 70%, which means the future growth which we are projecting for next 5-6 years is going to come out of borrowings. So with the result, the leverage, which is currently, the debt equity is at around 1.5, is likely to go up to say 4 to 5 times, and we are comfortable with that. And that will be the growth path, and that will be the way in which the growth in business will be funded. So it will be totally out of borrowing. That is the first thing. Next thing is on the yield which you are talking about, 80% is fixed. Yes, I don't think we have been following this practice right for the last 15 years. We have not lost any customers because of the rates we are charging. And if you look at our interest rate, we are charging around 15 to 15.5% on the housing loan. On the housing loan, we are charging around 17 to 18%. And on the non-housing loan, we are charging around 21%, which is comparable with the people with the interest rate charged by the peers. And also in the case of small business loans, it is 2 or 3% less than the market rate. So we don't see that kind of there will be a pressure on us to reduce the interest rate, or we'll be losing customers because of this. Just to add to what Mr. Balai said, on the liability side and the funding side of about 6,000 crores, there's about 56% is only from the bank. Outside the banking system, about 45%, largely coming from the NHB, securitization, and on the other, the NCDs that are raised with it, the fixed tenor and the cost. So that is no variability in that. Within the banking, bank borrowing also, that is while the tenor is long term, we have always gone for a long term tenor, of 4 to 5 years minimum. But in some cases, there is a variability coming, on the interest rate side, linked to either the repo rate or the MCLR. So when we say the variable, loans, it is not really the entire loan is variable. Only that part of the loan which is taken from the bank, and within that also, partly it is fixed, and partly it is variable, either linked to repo or linked to the MCLR. In fact, last 3-4 months back or 6 months back, we decided not to really take any loans, not to take loans only mainly linked to the external benchmark like repo, rather than the internal, benchmark like MCLR and all. So to that extent, the variable component is somewhat manageable and required purely to support the growth in funding. Okay. On the asset side, you are right, 80% of is a fixed rate, where in case of interest situation, a reduction in interest rate as and when it happens, you may stand to get benefit because of the fixed nature of the loans. At the same time, going by our past experience, the pre-closure rate in our case is much, much lower. It is not more than 2-3%. The overall pre-closure rate is around 7%. Of that, about 4 to 5% is the money coming from the customer their own source. It is not really coming out of a loan transfer, really. So our experience in pre-closure is very limited. And to that extent, the customers are, we anticipate that unlikely to change in terms of
when the interest rate, if at all, it comes down a bit. And while we will stand to benefit, but the risk of repressure is much less for us. Of course, variable is about 20% that you have the success.
Understood. Thank you so much, sir, and all the best.
Thank you. The next question is from the line of Shivam from Abu Dhabi Investment. Please go ahead.
So can we start giving the private versus PSU bank breakup in our borrowing? Is it possible?
You're not clear. Voice is not clear, Shivam.
Well, I'm saying, can we start giving the private versus PSU bank breakup in our borrowing?
Sorry for interrupting you, sir. Your voice is not clear.
Can you hear me now? Is it better now?
Yes.
Is it better now?
Yes,
Yeah.
sir, it is clear.
So, yeah. So can we start giving the private versus PSU bank breakup in our borrowing?
What is that? Breakup in borrowing. PSU bank in. See, if you look at my total borrowing, bank borrowing is 59%. Of that, around 25% will be from PSU bank, or maybe 30% will be from PSU bank, and the balance will be from private sector bank. And as I said, NHB is almost 19%, NHB borrowing, and NCDs are around 11%. The balance is in the form of securitization.
Okay. So can we start giving this number directly in our investor presentation? Will be helpful from the next quarter?
That is not an issue, yes.
Okay. And the second question is the bifurcation of the variable rate borrowing between the repo rate and the MCLR?
I'll tell you. See, of the total borrowing, EBLR, the borrowing linked to the external benchmark rate is around 20%. The borrowing linked to MCLR is around 32%. Fixed is around 48%.
Okay. And so right now, as the regulators are very hard on high interest rates, so what is the interest we are charging on the small business loans?
We are charging 21%, which is reasonable according to us. Yeah.
Okay, so there is no
large part of our portfolio being a home loan company. The large part of portfolio is really in the home loan, where we charge an interest rate of around 15 to 15.5. The second large component is the quasi home loans, where we charge about 17.5. Now, then there is the smaller part in terms of the SME loans, where the interest rate is around 22%. But that, really because the RBI regulatory concern is really more in terms of the, unsecured loans, small loans, flowing out of microfinance, flowing out of fintech companies, and the term that they use is usurious interest rates. So we don't really come under this category.
So we are not thinking of reducing the interest rate from 21 to something like 20%, right? Quite a few companies operating in the segment, in that particular segment, and our rates are quite comparable, and we don't see the job the natural usurious interest rates.
Okay, understood. Thank you, sir. It's been 13 quarters since and we are giving the quarter-on-quarter growth. So congratulations on the good set of numbers, and hope to see the good numbers in the future quarter also. And by the way, sir, the 30% growth rate for the next 5 years is comfortable, right?
Yes, next 5 years we'll see, at least for next 3 years it is there, 30% will be there.
Okay, at least for 3 years, okay. Thank you, sir.
Yeah.
Thank you. The next question is from the line of Yash from Citigroup. Please go ahead.
Hi, sir. Thank you for taking the question. So a couple of questions. First is on the ECL provisioning, where, ECL provisioning to total AUM in this quarter has slightly, gone down to 1.03, whereas, we've been guiding of comfortable range of 1.05 to 1.1%. So how do we see it moving, and would it inch up in the 2H of this year?
It depends. If you look at the, obviously the provisioning depends on the quality of book and the quality of collection. Okay. So if the collections are happening very on time and if the collection efficiencies are good, I don't think we should increase the provision. So we'll be maintaining around 1 to 1.03 provision, 1.03% as the provision coverage ratio. So it will be ranging between 1 to 1.03%, and this will be continued because, as I said earlier, if you look at the total provision which we are having, almost 45 crores we are having as management overlay. The provision required as per the ECL model, which has been tested by 3 auditors. One was the model was tested first by EY, then the next it was done by CR, then the new auditors, Sundaram and Srinivasan. So they are all okay with that model. And with the result, the requirement is only 55 crores. So I'm having additional 45 crores as management overlay. So I don't think I'll be increasing the overlay from now on.
Got it, sir. And sir, any incremental color on the 30 plus DPD book, which is still at the elevated level, so in October and first week of November?
No, the collection efficiencies are improving. As we have been saying, the third and the fourth quarter, definitely the collections will start improving, and 30 plus DPD will come down, because that's what is the focus from our point of view as well. So it will surely come down.
Got it. And so last question on the borrowings. Even in this quarter, we saw a good growth in borrowing. So were they more front-ended for the 1H, or we'll see the similar traction in 2H as well?
I didn't get your question.
Sir, on the borrowings, so there was a good growth, sequential growth in borrowings in this quarter as well. So was it more front-ended for the year, or we'll see the similar traction in 2H of this year as well?
Normally, we maintain 3 months or 2 months disbursement as on-balance sheet liquidity, and another 1 or 2 months disbursement requirement has been umbrella sanction. So it is just that playing a part. And also, we received this proposal from IPO Mutual Fund for 300 crores, which was at a very good rate. So we thought we should take that opportunity and draw that fund. So that is why our balance sheet, on-balance sheet liquidity has gone slightly.
So actually, as it was seen in the presentation, total liquidity in our system is about 1,200 crores. Of that, there's about 689 crores is really the unencumbered cash. We have the funds with us. That includes the money that was drawn in the last week from the potential issue to IPO. Apart from this 689, is our cash on the balance sheet, we have the unavailable sanction of 550. These funds are not drawn yet. But then, we said this 1,239 crores is comfortably cover us, in terms of our business growth. We almost, given the collections and things like that, almost cover up to February, March kind of place.
Okay. And so lastly, on the attrition rate, how are we moving? Have the trends improved, and any new initiatives you've taken on that front?
If you look at the attrition rate, I would like to divide this between across levels. Of course, at the top management level, the attrition is nil. At the middle management level, considering the cluster area managers, AVPs, and cluster managers, it is between 5 and 10%. And of course, at the branch manager level, it is between 15 to 20%. And at the sales officer level, it is between 25 to 30%, which is less than the industry, but still it is a challenge to be handled.
Okay, sir. Thank you so much. That's it from my side.
Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, sir. Am I audible now?
Yeah.
The first question is around the yield, sir. The blended yield is at around 17.5%. Can you give out the yield asset as well?
Only the first sentence was earlier, so after it's not. So what I will do, I'll have your number. I'll give you a call maybe after the.
Sure, sir. I'll probably do that. I'll get off the queue. Later you can give it to the next day. Thanks.
Yes.
Thank you. The next question is from the line of Nischint from Kotak Institutional Equities. Please go ahead.
Hi. Just two questions. One was, on the lab side, our growth is sort of a little lower at, I think, around 12% year-on-year. And I think even in case of state of Tamil Nadu, our growth sort of, still lags significantly lags the overall company level growth. So, just what are the thoughts here?
Nitin, not clear on the question.
The lab growth, see, if I look at your overall AUM growth, which is at around 27%, growth in LAP is around 12%. So, which is significantly lower than the company level average. Is there any specific reason why growth is lower over here? Is there any asset quality stress, any execution stress, anything that you have seen because of which you have got?
Nothing related to the asset quality. If you look at the collection efficiency, or if you look at the 30 plus BPD, it is all in line across products. It may be 0.2% here and there, but it is in line, whether it is 30 plus BPD or whether it is NPA or stage 1 asset. So there is no worry on the asset quality, because our credit norms, whether it is a housing loan or a LAP, it is the same. The LTV norms are same, installment to income ratio is same, the way in which we do the credit appraisal is the same. So there is no difference there. So it's basically because we have to do more housing loans, because we need to take care of the compliance fund factor. It is because of that has happened. However, if you look at the total composition of the book, in terms of the consolidated basis, it is around 61% on the housing loan and 15% on the quasi-home loan and 20% on the small business loan. So that will be continued. So that is the way in which we need to look at the mix rather than quarter-on-quarter disbursements moving slightly here and there.
Yeah, I got it. So basically, it is just because you wanted to comply with the 60-40 ratio.
Yes.
And that is a simple reason why you left. Got it. And the other thing is, in the state of Tamil Nadu, I know we've sort of, ramped up in the last 2 quarters. But when do you think we go back to, Tamil Nadu to company level average growth?
Sure. See, what is happening? First of all, let us understand this fact. In Tamil Nadu, first of all, there is no market-related issues. Market potential is good. We need to do the market, the ability of us to grow in the market is very well there. Yeah, but as you know, we were facing this acquisition issue in last September, and we have been slowly making changes and then bringing about improvements in the way that Tamil Nadu is performing. If you look at the half-yearly growth, it is around 8 to 9% is the growth in disbursement. And the AUM growth half year, September 24 as compared to September 23, is also 8%. We have made some structural changes in the team, and that is actually paying off well. And in the third quarter, you can see much more improvement in the Tamil Nadu performance.
So is it something to do with internal to the team, change in team, or is it something because the market is kind of...
Basically our internal issue, which is getting sorted out. It is not relating to any market related thing.
Got it. And just since there are a lot of questions related to the regulator that are coming up in this call, is there anything that the regulator has sort of in your discussions commented on growth or margins or asset quality? I mean, if you could clarify, that could just help us.
Let me clarify here very clearly. NHB inspection has been completed for us for the year ended March 23. We have given their comments and we have also submitted our response. There is nothing alarming there. And they have suggested some process improvements, which we have committed that we will also do that, and we will do that as well. That is on the NHB. If you look at the RBI, for the NBFC, RBI inspection took place 5 years back, and there were no major observations at that point in time. And of course, they have just completed the inspection now, and they have gone back. They have yet to come back with their comments. They told they will have a call with us before finalizing on the comments. And from what we got to know, the final discussion I had with the person who conducted the inspection, he was quite comfortable with the way we are doing the business, and there were no input from the RBI on either the growth or the interest rate or the yield which we are charging. So this is the feedback as of now. Just to add to what Balaji said, so basically our portfolio about 9,100 crores, 7,300 crores, which is the parent company, housing company, which is really secured loan for for home or for deposit, which is also secured loan. And the interest rate that we charge is like any other housing company. The housing company's interest rate never been seen as a usurious by the regulator at any point in time, as you know. So the housing loan, quasi loan, which almost contributes about 70% of our balance sheet, which is the parent company, housing company, regulated MSB, supervised RBI, there is no issue. From the point we have small, unsecured loan, and not clear about the terms and conditions, those issues. Now, the RBI, if you read the RBI, the concern, regulatory concern, largely, as you know, it's on the unsecured loan given to small customers by certain illegal entities like microfinance companies or few fintech companies. We are not really present in any of the unsecured loans. We are not present in the small loans. The loan that we are talking about, 50,000 to 3 lakh startups, we are not present in a segment. And our interest rates are fairly well communicated to the customer in English and in vernacular language. All the terms are fully disclosed, and we have also made a Infracon comparison our terms and conditions of the loans that we give. There was 8 other companies. We found that the service charges that we charge or the for regulators also use payment charges, for example, for repeaters and things like that. We are really quite comparable, and so that way we don't really see any concern and we don't have any loan in terms of the other uses in terms of the loan being netting off. We don't do any netting off loans, and we don't do any all other regulatory things are fully and totally compliant, and it is transparent to our customers and to the regulator and to us. So we don't really see anything, any concern on that for us.
Got it. I think this just helps to clarify. Thank you very much and all the best.
Yeah, sure. Thank you.
Thank you. The next question is from the line of Kartikeya Kumar Pandey from Ashika Broking. Please go ahead.
Hello.
Yeah.
Hi, sir. Am I audible?
Slightly not clear. You continue, we'll see.
Yes, sir. So you were explaining a few minutes back about the...
Sorry for interrupting you, sir. Your voice is not clear. Could you speak a little loud?
Hello.
Yes.
Yes, so you were talking about the effect of rate cuts on your fixed portfolio, fixed assets portfolio. So can you please explain that once again? And I missed out at the beginning.
I'm not able to hear you properly. Sorry about this.
Hello.
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 Please use handset while asking a question.
Yeah, I'm using handsets. I was just trying to understand what Joe was explaining regarding the effect of rate cuts on the fixed rate portfolio. So can you please just explain it once again?
Okay, just note down my number. You call me a little later. I'll explain what you are reading. It's 9791.
Yes, sir. 9791.
9791007160. Just give me a call after this. Yeah.
Okay, thank you.
Thank you. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. Can you share the disbursement number for Tamil Nadu for the quarter Q1 and Q2?
No, let's not get into, then please don't ask us Tamil Nadu, then cluster, the branch. See, as a company as a whole, we have grown,
certain percentage in terms of our loan book has grown 27%, our disbursement has grown 16%, and we are given a guidance of 30%, which we will do. And even the 15%, disbursement growth will move into 20%. We expect to move into 20% by third quarter. We move into 28% by third quarter, fourth quarter, and our loan book will grow 30%. We are growing in, as you've seen in Andhra, we are growing in Telangana, we are growing in Karnataka, we are growing in and then as for the Tamil Nadu, we have explained enough in terms of we have certain issues in terms of staff acquisition, which we have corrected. Beyond that, we don't want to get drilled into in terms of Tamil Nadu, which is which cluster, which branch, which sales staff. I think we need to stop it somewhere.
Sure, sir, sure. But in Tamil Nadu, the issue is that 2 years back, I think that issue has happened. And for last 2 years, the growth is still...
Otherwise, we won't confidently say that we will grow 30%. No, basically, what is happening, it's not that easy. It's a business, okay? So, there is a problem that needs some time to get sorted out. See, the thing is, you don't get fully experienced and good people immediately. So even if they come, they might not get adapted to the work environment. So there are issues. It's not that it's not a plug and play model where you just have some people and then ask them to perform and then start doing things. So it is taking time. As we have been saying, it is taking some time. But we are on the right path in correcting the Tamil Nadu thing, and we are correcting it also. And there has been a growth of disbursement of 8% over the last half year. So I think we should respect that and then take it forward, because it is taking some time, and we all accept that. But we are on the right track on that. So that is how we need to look at things. But that doesn't, as I said again, there is no market-related issues in Tamil Nadu. It is basically our own internal issues which we are sorting it out. That's it. Okay.
Okay. And secondly, in terms of sourcing, there is a significant, I think, there is sharp increase in the share of construction ecosystem. And over a period of time, customer referral share has also gone up. So what we have done there to show strong growth in these two channels?
So basically, we have formed a team at the head office. See, what happens is we have got the customer app. So where the existing customers can refer the leads. Similarly, we have got this construction ecosystem partners who are basically construction shop owners like paint shop owners or cement shop owners. So when somebody comes and buys something from them, they ask them whether you need a housing loan, and then they refer the same to us. And once the leads come in, what we do at the head office is we go through the leads, we talk to the customer, we do a bureau check, and make this cold lead into a warm lead, and then take it forward. So that is what, and that is being done in a focused manner. If you look at it, 18% of our disbursement last quarter came through these channels. Now it has become 20%. And we find that this channel is really good because the conversion ratios are also high, and the average ticket size is also high at around 9 to 9.5 lakhs. So we would like to focus on this channel and develop this channel, and that's what we are doing.
And lastly, how is the experience in the state of Odisha and Maharashtra? I know it's still a new states, but in terms of disbursement ramp up, how, if you can share some data on there?
Sure, it is very encouraging. We have got, if our experience was not good, we wouldn't have opened the branches there. So our experience in Odisha and Maharashtra has been good, and we have formed a team now. It is led by cluster managers there who are seasoned enough and experienced enough. We can take this to the next level.
Okay, sir. That's it from my side. Thank you.
Thank you. The next question is from the line of Jigar from B&K Securities. Please go ahead.
Yeah, hi. Congratulations, sir, on a good set of numbers. Two questions. The yields that you mentioned on HL, Coffee HL and SBL of 15%, 17%, and 21 to 20%, these are disbursement yields or these are book yields, and do they differ materially? Just trying to understand whether we have reduced rates.
Disbursement deal. Basically, it is the disbursement deal. We charge 15% on the housing loan. It is 17 to 17.5 or 18% on the quadri home loan and 21% on the small business loans.
Right. And we have not reduced rates recently on SBL per se, right?
We have not increased, yes.
No, we have not reduced.
The interest repo increase in the repo rate of past about 2.5%. Our increase in interest rate is much less than that. Only around 0.5 to 0.75% overall. So we have really consciously gone for a lower increase in the interest rate in that way. But we did it sometime in September 23 or October 23. After that, we have not done anything.
Understood. And sir, on this interest rate cut and 52% of your borrowing either linked to EBLR or MCLR. So if and when the system-wide rate cuts happen and they flow through in EBLR and MCLR, our spreads definitely will increase because a large part of our book is fixed rate. So do we intend to kind of pass it on to our customers, or we will kind of maintain it, the yields at the current level?
The last 2 years we observed the interest rate is largely, I mean, we may or may not pass it on. Particularly for the fixed interest rates. Contract point in time will be there.
Okay. And sir, any clauses you have on this fixed rate book that is, this remains fixed throughout the tenure of the loan, or does it get repriced, say 1 year, 2 years? Is there a review clause in the agreement?
Fixed rate contract, the loan agreement does have a clause to say in exceptional situations, the company can, raise the interest rates. Recover part of the increase in interest rates in exceptional reasons. So the loan agreement does it. It is not, it is fixed by our practical purposes, but in case of exceptional situations, the company does have the right to go for an appropriate increase to recover the cost.
Sure, sir. Thank you so much for answering the questions and best of luck.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good evening. Congrats on strong performance. So many of my questions are already answered, only a few left. Sir, firstly on the employee cost, it was flat on Q-on-Q basis despite a very sharp jump in disbursements. So can you share the employee count change on Q-on-Q basis, and how are the incentives structured for employees?
Incentive structures, I don't want to tell it in the concall because it's a company specific. Basically, incentives are being paid based on the performance, which will enhance productivity. So we are a productivity-driven organization. So anybody who performs well will earn good amount of incentive, and maybe a fixed salary will be 60 to 65%, and 35% will be incentive. Actually, just to add on that, as far as the numbers are concerned, staff numbers are concerned, we have closed September with about 3,000. And in March, we possibly had 2,700. 800. So we have increased about 200. And in this time, we have also added about 32, branches. So, and this increase also came, largely and mainly in the branches and the field level functions like sales and collection. We also very happy and increase that way. As far as incentive is concerned, it does recognize the performance both in terms of quantity and quality. And quality in terms of the proposal, the quality of the proposals generated, the track record of early default, the track record of installment payments, and the quality of documents that have been completed. As well as it does not become disbursement number alone. It does take into consideration other qualitative aspects as well. Even in the collections also, it is not by the receipts alone. there's a weightage given for the EMI. The EMI is more. We recognize the quantum of EMI. We recognize the number of receipts. And more importantly, we also recognize whether the EMI of the current month or the previous in a collection of old EMI money. So the incentive structure is largely for our sales and collection recognize these aspects of productivity and and quality.
So on this OPEX to asset ratio, I mean, we are at 2.65 and we are talking about being the lowest cost to asset and cost to income ratios in the sector. So what is the juice left and what will be the key drivers here? What can drive it further down and up to what level do you see it going?
There is no juice left, Rajesh. I mean, each and every expense is just monitored very closely. We negotiate better and also the productivity. That's what is the secret success. I don't think we can improve further on this. Yeah, as a culture of our we follow a frugal culture. That does not mean that we pay the lowest salary. Our salary is one of the best possibly in the industry comparable here. And our terms of employment, our salary levels, our these, those aspects. But then our investment in IT, our investment in branches, even this year we're planning to, as Mr. Balaji said, we will be adding about 15% of our branches. We are beginning whatever branches we have, we are adding another 40 branches we are going to add. So despite the investment, and we also invested in the new software that has been mentioned little earlier. So we do make the investment in terms of in the distribution, in the IT. At the same time, we are very conscious that significant part of our growth has to come from the productivity of our, from the existing branches, from the existing staff, and the new staff, after we least, turnaround time. So in other words, more, of course, as an organization, we do believe in a frugal way of pure culture, way of operation.
Just checking and clarifying this 291 branches that we report. Is there bifurcation? Are there separate branches for the NBFC and the HFC? And how does the sourcing happen across branches for all products? Can you just throw some light on that?
There is no separate branches for NBFC. Since the NBFC is the wholly owned subsidiary, the cost gets shared between the companies based on the assets under management. And as far as the sourcing is concerned, people are free to log in either a housing loan or a non-housing loan. Of course, there will be some push from the head office side on how much small business loans are being done at each branch, and of course on the housing loan.
Okay, understood, sir. Thank you so much, and best of luck.
Yeah, thank you.
Thank you. The next question is from the line of Kushan from Morgan Stanley. Please go ahead.
Thank you for taking my question. I had two questions. One was around the loan growth. So we have guided for 30% loan growth. In the near term, if I look at F25, that broadly looks at an ask rate of about 2,400-2,500 crores disbursement in the second half of F25. Is that something that we are targeting? Secondly, my second question was around the loan spreads. So over the last 2-3 quarters, we've broadly maintained a loan spread of about 8.7%. Is that something that we would guide to maintain going forward as well? And in that context, I mean, how do you think cost of funds will play out from here on? And also the higher liquidity on the balance sheet that you alluded to, over what time frame would that come back to a more normalized level? Yeah, those are the questions.
Currently, we have disbursed around 1,600 crores in this last 6 months. And another 2,000 to 2,100 crores is a possibility. Okay, so which means another
I will try to assume do more, but this is definitely it will be there, 3,700 crores. But definitely we'll try to touch 4,000 crores of disbursements this year. So that is the guidance which we want to give. And I suggest, what is the next question on the spread, right?
It was on the loan spread. Yeah.
Yeah. See, spread is a resultant of what? Yields and the cost of borrowing. Our spreads are likely to be maintained at around 17.37 to 17.5%. And cost of funds are currently it is at 8.5 to or 8.7%. Of course, if the rate cuts happen, then obviously this interest cost will come down, at least on the variable rate borrowing. So to that extent, there can be a NIM expansion, but I'm not factoring in that as of now because the rate cut has to happen. So with the result, the spread is likely to be maintained at 8.7%.
Understood. And lastly, just on the liquidity part.
What was the question on the liquidity?
So liquidity had increased Q1 this quarter. Just wanted to understand in what time frame will that normalize to earlier levels?
It is basically 3 months disbursement we would like to drop disbursement which we would like to maintain as the liquidity. Whether on balance sheet or off balance sheet, it will be determined based on the market, based on the availability of funds and also the market dynamics. So, for example, last quarter we had to draw that money because the rate was good and the terms were good, and then it was from a mutual fund. So we had to draw the money and keep it on the balance sheet. But normal plan is to have 3 months gross disbursement as the liquidity available.
Understood, sir. That's from my side.
Thank you. As that was the last question, I would now like to hand the conference over to management for closing comment. Please go ahead, sir.
Yeah. Thank you for organizing the conference call. I would like to pay my sincere gratitude to all analysts and investor friends who have taken time to listen to us today. Please feel free to contact Mr. Balaji or any of us in case you have any further queries. Thank you. Thank you. Thank you all.
On behalf of Dolat Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your line.